a serious money. This can be greatly helpful to all of you. With this background, now let me share the Excel sheet. Is it available on your screen?
Yes, sir. It is coming up. Not yet shared. Yeah, now it is up.
Okay. So the point is, if you really look at this is a Titan company's Excel sheet. If you look at this, what it contains your P&L account, which is nothing but your income statement, which is annual P&L account of last 10 years. It also gives you quarterly results of last, I think, 2 years, some 10 quarters results. It gives you the balance sheet. It gives you cash flow statement. It gives you ratio analysis. It gives you DuPont analysis, right? And that's all. Now, having said that, when you have so much of thing on the platter, right, it's a problem of plenty. Right or wrong? It's a problem of plenty. Let me here ask you, let us have an interactive session. Is it okay with everybody? So let me ask you, when you want to do the fundamental analysis, what is the first thing you want to know? Those who have attended Mumbai meet may be aware about this. What we normally ask ourselves first, अगर हमको कंपनी के बारे में कुछ भी नहीं मालूम है तो हम सबसे पहले क्या जानना चाहते
Revenue.
earnings,
हैं? अर्निंग्स. ओके, अर्निंग्स के पहले क्या आएगा?
Growth.
sales, sales,
कंपनी क्या बनाती है, किस चीज में है, क्या करती है.
करेक्ट करेक्ट. ये कंपनी का कहानी क्या है? करेक्ट, मतलब ये कंपनी करती क्या है? राइट और रॉन्ग? और अगर मैं बहुत ही रिफाइंड वे में बोलूं तो ये कंपनी पैसा कैसे बनाती है? राइट और रॉन्ग? ये बंदे की कहानी क्या है ना? मतलब हम ये जानना चाहते हैं. अपार्ट फ्रॉम क्वालिटेटिव इंफॉर्मेशन लाइक कौन से बिजनेस में है, एक्सेट्रा एक्सेट्रा, ज्वेलरी में है, कौन से सेक्टर में है, कितने साल से, इसका हिस्ट्री क्या रहा, इवोल्यूशन क्या हुआ, ब्ला 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 ब्ला. लेकिन जब हम टेक्नोफंडा एक्सेल शीट पे आते हैं तो हम सबसे पहले ये क्वेश्चन पूछते हैं, या एटलीस्ट मैं पूछता हूं कि बॉस ये कंपनी का बिजनेस क्या है, ये कंपनी का कहानी क्या है, ये कंपनी पैसा बनाती कैसे. एंड फॉर दैट आई ऑलवेज स्टार्ट विद DuPont analysis. So many times you must have seen that whenever any request come to me on the weekly meeting to help the concerned person on Technofunda sheet, I start with DuPont analysis. In DuPont analysis, if you really see the 3-stage model, it tells you, now if you look at last 10 years data, right, what is your observation in net profit margin? That except March 21, if you really see, it is around 5.3 to roughly around 6, 7, 8% kind of this thing. We do not see a major volatility in the margin. So it's a very stable kind of a margin, and it is hovering around 6 to 7% kind of margin business. So it's a single digit margin business. What is the asset turn of this company? More than 1. See, in the history, it is always more than 1. So if they put 1 rupee into the balance sheet as an total assets, their sales is always more than 1. That means efficiency is good. This speaks about efficiency. Profit speaks about operations of the company. And the asset turnover speaks about efficiency of the company. And the equity multiplier, that is, अगर मैंने बैलेंस शीट में 1 रुपया इक्विटी में डाला है और मेरा बैलेंस शीट का टोटल एसेट 4 रुपया है, तो मैंने मेरी बैलेंस शीट को 4 टाइम्स लिवरेज किया. दिस इज कॉल्ड इक्विटी मल्टीप्लायर. तो बाकी का 3 रुपया मैं बाहर से लूं. Now here if you see, let us see the asset turn, तो we have seen, let us see the equity multiplier. Now equity multiplier यहाँ पे, it is always, if you take average is also 2.2. And currently it is way above the average, that is 3.4. But that is look like to an outlier if you understand statistics. This is more or less 2.2, 2.3 is the kind of equity multiplier they have. That means अगर ₹1 कंपनी का खुद का है या ओनर्स का है या शेयर होल्डर्स का है, तो बाकी का पैसा 2.2 or something like this is an outsider's money. 1.1 is outsider money. In this case, it is almost ₹1 के सामने करीबन ₹2.40 बाहर का है. जब बाहर का पैसा आता है तो सबसे पहले क्वेश्चन ये आता है, when the outsider's money come, which source it is come, from which source it is coming. Correct? We go to the balance sheet and we try to go to the bottom of the balance sheet and try to see that their borrowing is 49% and their outsiders money, which is not interest bearing, is 21%. And more or less, if you see, their borrowing is always more from March 19 or March 18 or whichever the year you take.
Maybe from the network issue.
I think.
Yes.
Yes, we lost
Yeah,
him.
just got this. Let me
Yeah.
this disconnected. So let me go to this. So if you really look at this DuPont balance sheet now, so we always see that they have a higher loans than the outsiders money. So major contributor to the equity multiplier is an outsiders money. That is interest bearing. Now that logically should raise the alarm that if the debts are more than the outsiders money, that drives the equity multiplier, whether debt is a problem in this company or not. So how you will come to know that debt is a problem or not? Then you should go to the ratio and try to see the interest coverage ratio. Right? You have an interest coverage? Yeah. So if you really see, the interest coverage ratio is fantastic. 8 times. So if I have to pay ₹1 of interest, I am earning before interest ₹8, 8.5 rupees. That means even though I have a 49% of a debt, the debt is not the problem for me because my interest coverage capacity is extremely good. So even if there is some headwind comes, some slowdown comes also, this debt will not break my business model or it will not break my balance sheet. That is something is very, very powerful thing to understand. If you're a lender, you might also use debt service coverage ratio also. But because we are an investor, I'm not dwelling into that. But Jamsetji or Natanji will understand what I'm talking in the banker. So having understood this, let's deep dive again into the DuPont. So equity multiplier is a safe zone. 2.2 is kind of an average they maintain. It is majorly driven by the debt, but that is not the problem. That also we understand. Their asset turn is also good and their margin is also good. Now, if we really see, the margin has come down in the March 24. It should ask you immediately the question, what has happened? Why it has gone down? Because we understand that Titan is a market leader, Tata company, etc., etc., etc. So why their margin has come down? So that answer you may try to find from income statement, that is the P&L account, March 24. And if you go to the bottom, first you will understand that their operating margin from 12 has come down to 10. Correct? 2% reduction. Why? So if you look at this, you understand that the major cost in this company is the raw material cost. Major cost is the raw material cost. If this company can bring down the raw material cost, then obviously it has a direct positive relationship with the margin. That is a very powerful understanding. But just for simple business, we know that in such case, maybe the gold is the major raw material. In their watches is a trading business. So they directly buy the watches, that is the main cost. And maybe sari business, which is a very small business. whatever the sari they buy as a trading item, that is the major cost. All put together, it is the raw material cost. And if you really see, in 2 years, this was 75% and it has gone to 77%. That means there is a 2% increase in the cost. Now the role comes that why this cost has gone up and why this cost is not passed on to the customer. That answer you will find in qualitative analysis, not from this quantitative analysis. And that is where now you know that in conference call what to find out, in annual report what to find out, in management interview what to find out, in any Twitter feed what I should find out, and try to find out answer to this. So now you have a quantitative analysis in place, you have a right questions in place, and you know as a qualitative analysis where should I go or what should I look for. I should not read everything line by line. Now, there are two possibilities. Either company is actually not in a position to pass on the cost, or company is in a position to pass on the cost but deliberately decided not to pass this cost. And that you may find out when you dig deeper into the qualitative analysis, when you read. And for that, you have a lot of tools, right? Management annual reports, management discussion analysis, interviews, equity research report. These are all tools available. If you come to know that management is not in a position to pass in the cost, that means it's an extremely competitive environment. If they pass on the cost, then they will lose the market share. Right? So the company decided that if I want to grow, I will grow at the cost of some margin, but I will not lose my market share. So you actually get some validation that there is a stiff competition. Hence, you should rule out in future projections, being very optimistic on margin expansion. I hope now you can connect with 4-cylinder. That is making sense. But if you come to know that company is actually in a position to pass on this cost, but they have deliberated choose not to pass the cost. That means what? It is like a strategy of Pidilite, or it is like a strategy of a Reliance to kill the competition. Now, if you find some company in such a position that they use their balance sheet, cash flow, and their financial muscle to kill the competition, then probably you are hitting on a treasure hunt. Then you must take a tracking position of such company and keep following the story, and if getting validations as per your process and system should add the tranche. I hope so far so good. I hope I'm not going fast or not going too complicated.
No, sir, it is
very clear, very clear.
Very clear.
Yeah. Now, if you really see the power and fuel cost, okay, it cannot be zero. There will be some issues of this thing classification. Now you see that selling and admin expense has come down further. So if you really see in the long run, what is their selling and admin expense? So you should see that if it is going down, right? On an average, it was 7%. This time it was in 21, it was 5%, and it has come down to 6%. Try to find out that why company choose to reduce, or in absolute terms, whether the figures remain same or more, but whether operating leverage is playing out. Try to validate that, when you go back to the schedules in the annual account, see these numbers, find out that the numbers are actually not reducing, but in percentage term it is reducing, and their sales are also growing. If you really see, their sales are growing from 40 to 51, right? Almost 10,000 crore. That means though it looks 6%, but it has not adversely impacted their sales. That means probably there are some fixed costs involved in this selling and admin expense, which now playing as operating leverage. But that is a hypothesis you need to go and check and try to understand why. Because if same trend continues in the long run, and because if you really look at, say from 11,000, it has gone to 51,000, 5x, almost 4 to 5x. So if you take next 10 years kind of a story, right, then you can imagine what kind of operating leverage it can have. So you cannot hold on to the multi-bagger unless you have conviction. And that conviction can come only when when you connect the dots, the quantitative analysis with qualitative analysis. So that is the, the first part on DuPont. So now, if you just go to the 5-stage analysis, then you will understand that tax burden is this 1 minus 0.76, so 24%, which everybody knows under Indian income tax scenario, that is nothing much company can do. Their interest burden is, as in from, so 94 means 6% of EBIT. Now it is 12% of. So you should ask this question. The interest burden has gone up. Why? Let us go to the balance sheet. From 35%, the loan has gone up to 49%. The loan has gone to 49%. If you look at absolute number, from 9,000 to 15,000. So their balance sheet size has though increased from 21 to 24, their debt has gone up by 6,000, 9 to 15, right? And their fixed assets, 3,000 to 3,000. So only 700 crore fixed asset has gone up. So majority of money has gone into other current assets. What is this other current assets? If you really see, they normally give in the balance sheet this breakup of other current assets, right? So it has gone up, but they are not giving their breakup. Yeah. See, their receivable has gone up from 674 to 400 crore. Here it is 3,000 crore and the balance 200 crore. Working capital has gone up by 3,000 crore. Right? So the point is how their receivable days are looking like. No problem at all. 6 days of it. So this increase in absolute number is purely because of increase in scale of the business. Number of days are under control. Their inventory turnover has improved. So the increase in the inventory is also because of increase in the scale, in the sale, because the turnover ratio is inventory turnover. And the debt to equity ratio has gone up. That we have seen. For the first time in the history, it has gone up above 1. Above 1. But as we know that interest coverage ratio is comfortable, we need not to worry. Correct? So their interest burden has gone up. Maybe, if we go to the screener, maybe they have started sari business or something. And maybe in that business, they are in the, must be playing. We have to connect the dots that try to establish that business, a sari business. And maybe initially it may take time to establish, but we need to connect the dots. I'm just assuming, because otherwise why this company should take, such a huge debt. Now, when I say so, the answer you may find also in some inferences in cash flow analysis. So if you see that consolidated 10 years aggregate PAT 16,000 crore, out of that 10,000 crore is the CF. Conversion is 63%, which is less than 80%. Now let us see 1, 2, 3, 4, only 4 years out of 10, it was above 80%. That means this is a working capital driven company, because if we really see the balance sheet, right, out of this, only 12% is into the fixed assets. Majority money lying into the current assets. So it's a working capital driven company. So if you really look at cash flow and even the balance sheet, if you look at 7% is in the investments. So their monies are getting locked into the working capital. They prefer to hold inventories and whatever the other current assets. And we have to accept this, that they will grow and their conversion ratio is always less than 80%. Now, if that is the case, the less cash flow is available and their entire capex, if you really look at, is 5,702 crore. 5,700. That means they have a free cash flow of 4,000 crore. Right? So their free cash flow is 40% and the reinvestment is 56%. So now they have increased their debt by 6,000 crore. And if you really look at the balance sheet, this 7% is lying into the investments. And this investment is worth 2,000 crore. So net to net 13,000 crores is actually on the balance sheet as a debt. The company may choose to take this debt because the cost of debt will not be very high as compared to the return ratio. So if we really see on this 15,000 crore, what is the interest they are paying? And we are just on direction, not on accuracy. So if we really see, the interest is 600 crore, correct? 619 crore. Now, if you look at the balance sheet and you take the average of this opening and closing is around 12,000 crore, 12,500. On that you pay 620. So 5% is the average cost. So if you are getting money at 5% and what you make out of your business model, if you look at this ratio that you are making, say 37 is an outlier, you are making at least 27, 23, 27%. And if you are getting money at 4 to 5%, gold metal loan and all those things that Kalyan Jeweller we discuss, there's a pure arbitrage of 20%. So why not to experiment? Their capacity to suffer is very high. Now underline the word capacity to suffer. That means it is your satellite game. Your capacity to take 10% loss is there because you are taking a tracking position. Your capacity to suffer is high. Even if you go wrong, it will not kill your balance sheet. So even if they start a new business and with a tracking position, like a small investment, and if they go wrong, it will not impact the balance sheet. But if they go right, it can zoom their return on equity and the earning growth. Now, this 27% they are earning and they have a 56% reinvestment rate. Now, just try to understand organically 56% into they are earning at least 27%. That means 15% organic growth is given in this company. Because 56% I am reinvesting and on an average I am earning 27%. So even if I do not do anything extra and just plow back this 56%, and I'm earning 27%, my organic growth is 15%. That is huge. That is huge. Right or wrong? I make 15%. So that means what this engine is telling me, that my balance sheet is strong, my return on capital equity or return on equity is strong, my cash flow is below 80%, but with these numbers, my 15% organic growth is given. It is given because just I plow back this profit, I will grow. Then company do capex and then company borrow, may do acquisitions, etc. New line of activity and try to grow the earnings beyond 15%. Now, if we really look at how they have grown their earnings with this understanding, if you look at this, right, PAT growth, 58, 26, 7 and 34, minus 125, 49 and 6. So in March 28, it was only 6%. Only. But if you look at a long-term picture, see, on a longer picture, it is always more than 15%. So you find an answer in this business model that 15% growth तो एक कंपनी का होता ही है, इसमें कोई बड़ा बात. तो लॉन्ग रन में 18% तो है, करेक्ट. सो दिस कंपनी अगर 18% ग्रोथ है तो आज की डेट में मार्केट उसको कितने का ईपीएस अपना पी दे रहा है? 80 के आसपास दे रहा है, 80 के आसपास दे रहा है, और लास्ट 3 साल का 50 के ऊपर का ग्रोथ है. Now with the qualitative analysis, we should find out with the management guidance and story and commentary, what is the future growth look like? And for that, we try to see the capex, we try to understand capex guidance, timeline of the capex, and we try to understand 4-cylinder and try to do the projections and do the reverse DCF, right? And many times I do on the Excel sheet when we are weekly meeting. And then we understand whether margin of safety is there or not. And this story, when you put it on the chart, right, then you will understand that if this kind of growth, if this 80 multiple is not justified, then if that kind of growth is not visible in the guidance, you will find that in the chart, it will be a downward trending chart. It will be downward trending. So if you really look at this the chart of, let me just open this. Now you can connect the dots with the chart. One second. Let me just go to market smith. So it will give you ready. Give me 2 minutes. I'll just log in and come back.
Yeah, Rupesh bhai, please take time.
Can you see this Titan chart?
Yes, sir.
Right?
It is up.
If you really see, their EPS strength is 77. Price strength is very poor. See the rating. And their RS line is going down. Right? Right? That means whatever the management guidance has come, the market looks into the future. Right? They are not in sync with this 80 plus kind of this P, which market is today giving them. The current P must be around 80. Right? 86. Current P is 86. So market is, and see, it is almost below their key moving averages. Right? So company is good, but it's not the good investments. So you can always wait, even if you're doing tranching in core portfolio, because if you look at a very long-term chart, it will look 45-degree chart. But the point is it the right time? Answer is no. Answer is no. See, it's a 45-degree chart. But today it is not the right time. And how we have captured this very good way is in this Super 30, which we have in Dhruva app, where this green dot will capture this, or yellow dot or blue dot will capture this. But now you understand the story behind this, that why market is not giving it the green dot. And when you keep tracking this company and when you see the first trigger that now this qualitative patterns are changing, which was like there 5 years or 7 years before, you may try to take some early entry with the tracking positions. And on the right side of the base, right, you can start building the positions much earlier. Because if you understand this, your conviction is high, then you will not even wait for that green dot into the Dhruva. You may start slowly, building up the positions. Because initially, if you have a low cost position and you know this story, because now the model is in your mind, when you read, everything will get connected. And as Kishan always say, your mind will work for you, right? So that will go in your favor and you can take much early positions even before, all of us in Technofunda take as per our process and system. That is the power of actually analysis. To just the repeat, analysis means quantitative plus qualitative and connecting the dots and then putting it on the chart and see how the chart, is, showing this picture. So that's what, in a nutshell, I have to share. Over to you, Kishan.
Super amazing presentation. Rupesh bhai, thank you so much for explaining the Excel sheet in detail. And before jumping to the questions, like I would highly recommend you guys to have maybe a broader view about the company, because now you know the fundamentals Rupesh bhai has covered. Okay. So your first and foremost step is to just go to your maybe desk and just maybe download 5 years annual report and just read all the management commentary, all the annual report, all the con call. So you can connect the dot from where the management is guided and how they have fared, whether the management is walk the talk or not. Because now you know how the company has connected with the fundamental view, right? We have got ready-made fundamental research available by Rupesh bhai, right? So you have to read more, right? Now we will open for the Q&A. So it is again, we have to respect like who is raising the hand, we will give the preference. Yes, Natanji.
Rupesh ji, thank you very much. Thanks for enlightening us. Rupesh ji, see, in fact, Titan balance sheet.
Natanji, if possible, you can turn on your video.
Now, 1 second. Actually, I'm tired. Yeah, right from the morning, I was doing this
Then too.
presentation. And then, okay, hold on.
Wonderful. Since you are a event head, you have to.
Okay.
Yes, sir.
Sir, if you see, the receivable is very, very low. 6 days, 5 days, it hovers around that range only. But then how come CFO slash PAT is less than 50% or something like that? What could be the reason?
1 sec. Can you see this screen up?
Yeah.
Yes, sir.
Now, just try to understand. Their debtors are 7 days, inventory is
Yes.
176 days, right? And days payable 13 days. So 171 days of funding they have to do, or money will get blocked into the operating cycle. Do you
Yeah.
agree, sir? Do you agree?
Yes.
Or
Yes,
even
yes.
if you say 7 plus 176, 183 days of funding they have to do. Out of
Yes.
that, 13 days of funding is done by the creditors, right? Now, mota moti, if you take, their sale is 50,000 crore, right? 51,000 crore. Now, even half of that is 25,000 crore, right? Or if you take their expenses 45,000 crore, half of that is 22,000 crore, correct?
Yeah.
Right? So around
Yes.
20,000 crore funding has to be done. Has to be done, correct? Out of that,
Yes.
their borrowing is 15,000 crore, right? 15,000 crore. I am assuming everything is working capital for the benefit of doubt. But if you take breakup, see the long-term borrowing is 3,000 crore, short-term is 9,000. So around say 12,000 crore is the short-term borrowing, correct? 12,000 crore. So it goes into working capital, correct? So out of 22, 12,000 crore is coming from here. 10,000 crore, roughly 9 to 10,000 crore should come from their own this thing, correct? And now if you look at their cash flow is such 1,700 crore, correct? Or their profit is around 3,500 crore, correct? 3,500 crore. So they need to borrow 7,000 crore or something like this from outsiders money, right?
Yeah.
That
Yes.
means that means out of this 3,000 crore, this 22,000 crore is actually the blockage into the working capital, correct? Of that 10, 12,000 crore you have a borrowing. So the balance will go from the profit only. Hence, their conversion into the profit has to be less. If you understand this engine, right, of operating cycle, right, the answer is very clear. That because it is a working capital driven business, the more you scale up, the more inventory, more debtors you need, right? And in gold business, you don't get much credit, so you do not give much credit. So that creditors are 13 days is a commendable. Actually, you're getting gold on credit.
So it is not due to not due to debtors. It's due to creditors as well as inventory.
Inventory. It's a working
mainly
capital.
due to inventory. Yeah,
inventory. It's an inventory. See, it's a 170. Almost 6 महीने का inventory.
Yes.
6 महीने का. तो अगर 45,000 का cost है, उसमें 80% तो inventory है, right? Correct? So inventory will be how much? 360, right? 36,000 out of 36,000 divided by 2, 18,000 worth of inventory. No? That needs to be funded. No, that comes from the profit and this thing. Hence the conversion is less.
Okay.
But is it a problem? Answer is no. So we should not think that 80% से नीचे तो खराब है. We should try to find out why it is so. That is how this engine is designed, and that is how this business is like this. Hence, we should not conclude it is bad. Once you understand that, then at least you will not make that mistakes of labeling it bad or something else, because you are validating with your understanding. Clear?
Thank you, sir.
I hope I'm making sense.
Yes, absolutely.
Yes.
Okay.
Thank you, Rupesh bhai. Yes, Kiran Bhatia ji.
Hi. Thank you, Rupesh bhai. Just two questions, just for the knowledge purpose. Now, the inventory is near about 178 days. Is this right? So, whatever I am selling today, can you hear me?
Yeah.
Yes. Yeah, loud and clear.
Okay. So, today, whatever I am selling, so it means that product which I have purchased 178 days before. Is this right?
No. See, it's a cycle.
It's a cycle. Okay.
So on an average, you keep 6 months of inventory.
Yeah.
So
Inventory.
you try to rotate that twice in a year. That is the minimum.
Twice. Yeah. See, now if you see the last 6 months, 1 year, the price was 60,000 rupees. Now the price has come to near about 70,000 rupees. So it means whatever the gold you have purchased at that time, it was at a lower price. Someone is talking. I will talk later on.
Yeah.
Yeah, Kiran ji, unmute yourself and now share.
Okay. So Rupesh bhai, hello.
Yeah,
Can you hear?
go ahead.
So
Rupesh bhai, you are mute. Rupesh bhai, you have to unmute yourself.
Sorry.
Yeah.
Sorry.
Okay. So it is just as a we are not going to the whatever we are selling today. We are selling. Let's example today you went to Titan showroom. You buy some gold. So you will pay 72,000 rupees roughly. We are talking about roughly. We are not going into exact science and all these things. So this gold you have purchased as an inventory before 6 months. We are talking so you purchase at 60,000 rupees roughly.
Sir, come to the point.
So that's what. So whatever the sales happening today, so it means they have purchased at that time. So this year sale, so that has gone up because of that reason. That is the first thing. Because I was just thinking, the interest coverage has also come down. Interest coverage. If you see, that's a second thing.